Welcome to Echo Trade. It's Jeff Roth again here with Justin Carbonneau from Validia Capital Management. So Justin, appreciate you taking some time. Good to see you.
Jeff, always good to join you.
Yeah. So today we're talking about the Dividend Achievers portfolio, but for those of you who don't know, Justin is a partner at Validia Capital. He's a podcast host extraordinaire. And if you haven't checked out his Excess Returns podcast, then definitely do so. Rounding out the team at Validia is Jack Forehand and John Reese. Jack's a chartered financial analyst, CFP as well, and John is got degrees from MIT as well as Harvard. So I think he checks those boxes pretty darn well. So glad to have the team, the expertise over at Validia. But yeah, we're talking about the Dividend Achievers portfolio. So curious to kind of get an overview. I always like to kind of start with giving you the opportunity to tell investors, what's the overall thesis of the portfolio? What are the kind of core objectives that you guys are trying to achieve within the Dividend Achievers?
Yeah, so first, let's start out by just talking about dividends in general. When investors get returns on stocks, they typically come from two different places: the capital return that a stock can give you, and then also the dividend if the company pays a dividend. So those two things are what contributes to a stock's total return that an investor achieves over time. And I would say throughout the last 100 years in the US market, dividends have accounted for a decent part. If you assume stocks have a 9 to 10% annualized nominal return, dividends have been somewhere around the 3.5–4% range.
Yeah.
Over the last 20 years, dividends have been trending lower. So companies don't pay as high a dividends as they do today, as they did maybe in the 50s and 60s. But certainly with certain companies, dividends are an important component to the returns that investors are getting. And this Dividend Achievers portfolio sort of tries to take the best of the best out of the dividend investing world. And these are companies that they're called the Dividend Aristocrats. So it's roughly the 60 companies or so in the US market that have paid dividends for 25 years consecutively and that have had increasing dividends on an annual basis in those 25 years as well. So what you're getting when you start with that list is you're getting companies that have delivered on these dividend payments over a number of different economic cycles, a number of different markets. And as an investor investing in those types of companies, you can feel confident that that dividend is likely to be paid and grow. Two important things.
Yeah, exactly. You have that security that the dividends are becoming, whether that's, from a form of income that you're relying on the dividend or to bolster the overall growth of the portfolio, correct? And so, like you said, just to kind of recap, you're talking about the Dividend Aristocrats. These are the cream of the crop in terms of dividend paying companies. But then, it's a 10 stock portfolio, if I'm not mistaken. So out of the 60 or so companies within that universe of the top tier of dividend paying companies, how are you then kind of funneling out to what the top 10 that are actually going to fit into the portfolio?
So what we do here at Validia is we construct fundamental investment strategies based on the methods from great investors, people like Warren Buffett, Peter Lynch, Benjamin Graham, John Neff, and a whole host of other investors that have written books about their investment approaches. And then we also branch out into the academic world, and we've identified other fundamental strategies that have long-term, time-tested performance behind them. Yeah. And we basically run all these strategies in the Validia Capital system. And then what we do with that is we score stocks based on the underlying strategies themselves. So in the case of the Dividend Achievers portfolio, and actually many of the other portfolios we run on Echo Trade as well, this system offers us a ranking ability of the stocks in our universe. So with the Dividend Aristocrats list, we can score all those stocks based on a composite score. So looking across all of our models, what Dividend Aristocrats achieve the best total combined score across all the different methods. And then that is how the selection process is made. So the 10 companies that score highest based on their value, based on their quality characteristics, based on their growth characteristics, their consistency and profitability characteristics, those are the types of stocks that get the highest scores. And so they're the ones that fill the portfolio. Now, we're not just buying and holding forever. There is a rebalancing approach. So a few times a year, we'll go in and we rerun this ranking system. And that allows us to make some changes where some stocks will be removed, some stocks will be added. And the reason that's done is because those ones that are coming in look like they're better opportunities than the ones that we're currently holding. But kind of consistent in all that is this like strong income / dividend grower characteristic, because all these companies have that to begin with.
Yeah, exactly. No, you're taking, the strategies that you didn't have to create, but you're aggregating them to be able to pull from. You're already pulling from the cream of the crop in terms of dividend paying companies, and then aggregating through these different buckets of strategies. And so you're literally going to get the best of the best of the best in terms of dividend paying companies. So
that's correct.
It's a great strategy. So talk a little bit about that. You mentioned, kind of you guys are rebalancing or kind of, updating the portfolio on a regular basis, kind of taking, the existing universe as well as what you guys are. And so if somebody doesn't score as high as previously, you're taking them out. So does that kind of tie into how you guys are actually kind of mitigating the risk of the portfolio and kind of ongoing and making sure that you always have the highest performing and the highest scoring stocks in the portfolio? And just talk about that, and then just kind of the overall risk of the portfolio and how you would define it relative to other kind of equity-based portfolios.
Yeah, so the rebalancing is more of an opportunity cost thing, in the sense that we want, when you're selecting stocks quantitatively, you want to be able to be getting the higher scoring names in the portfolio. Yeah. So it doesn't necessarily mean that it's going to be less risky. It just means that what you're trying to do is you're trying to let the most fundamentally sound companies come into the portfolio, and you're trying to do it in a disciplined, consistent, and repeatable way. Yeah. And what you're trying to get out of that is you're trying to get a little bit more alpha, trying to find a little bit more opportunity, in the overall basket of portfolio of stocks that you're holding, to try to deliver the best long-term return we can to the investors in this portfolio. In terms of mitigating risk, we're equally weighting the positions. It's a 10-stock portfolio. These are very concentrated, so I can't say that they're going to be less risky than a broad market index, because something like the S&P 500 holds 500 companies, even though that's market cap weighted. We're holding 10 companies. So there's clearly a lot more stock specific risk in our portfolio, because each position will roughly be about a 10% position in the portfolio. But that level of concentration also provides nice upside potential. We're getting a lot of the benefits of diversification. And then just in terms of how the portfolio looks and feels in terms of the holdings, these aren't like some crappy small cap value stock that someone's never heard of, or some high flying growth stock that trades at a price to sales of 30. These are reasonably priced blue chip like companies. You would look at them and think probably long-term compounder, stuff that Buffett would probably like to own. And, you're getting the investor base as part of these companies, because they're a dividend aristocrat. You're getting high quality shareholders that own these things. So with that being said, you tend to get stocks with lower, betas that are more in line with the overall market. These things aren't seeing, 50% standard deviation variability year to year. They just tend to be more stable companies because their businesses are more stable. That's a reflection in the consistent dividends payments. And it's also just a reflection in the underlying fundamentals, whether it's more consistent profitability, consistent growth rates, the balance sheets are mostly solid. So all those factors sort of play into this type of portfolio is certainly appropriate for someone that's looking for sort of the high quality dividend paying types companies, but they want something probably a little bit more concentrated and maybe something a little bit more active, because that's kind of where that's a spot we'll fill.
Yeah. So, you accomplish, you have a little bit of more potential volatility with, and you have just the natural, risk with the market exposure, and the concentrated factor of the portfolio adds a little bit more potential volatility, but you have the further upside, and then just the nature of the companies that you're investing in. Again, the dividend aristocrats that have been paying dividends and increasing dividends, they're blue chip companies. There's a sturdiness factor that comes along with those types of companies versus, like I said, a no-name, startup or growth, kind of small cap stock that could potentially likely have more volatility than some of the blue chip companies. So talk a little bit about then, diving into kind of why you guys look at the dividend, what kind of, the goals are within dividends specifically, and are there any market conditions that suit this portfolio more than others, or kind of what specific goals would I have that would lead me to invest in a dividend achievers portfolio versus, something that's more on kind of the value side or the growth side?
I think that the one thing that this portfolio will provide you with is, because you have the consistent dividends, there's going to be some type of return. If we go into a low return environment, or an environment where stocks just don't do that much, and that's not your normal year. Your normal year in the market, there's so much variability in year-over-year returns. But you could have a year where the market's flat. I mean, you're going to get those consistent dividend payments. That's going to help drive returns. I think that's one important thing. I think that there's a lot of investors out there, not necessarily younger investors, but older investors that are looking to meet some type of withdrawal rate. So if you know that you're withdrawing 4% of your overall portfolio down a year to help pay expenses, then a dividend type strategy can be important and help meeting some of those liabilities. So rather than investing in, bonds, you might decide to invest in dividend paying stocks and use the dividends. You made a great point earlier. Dividends some people don't take them out of the account. They actually just reinvest them. They plow them back in. And that's a very powerful way to make compounding work for you. It's just, this type of portfolio, because it has that strong dividend component to it, it could be appropriate for that type of investor that's taking withdrawals. And certainly, I think in a market where the leadership gets narrow and investors are seeking quality. Now, why would they seek quality? They may seek quality because there's concerns about a recession. They may seek quality because there's other types of headwinds in the market, whether it be rising interest rates or inflation or something like that. There's risks. And so I think investors might come into stocks like the ones that we own in this portfolio because they just are higher on the higher quality spectrum. And so, you tend to get these throughout like a market cycle, you have these different regimes throughout the cycle where different types of stocks are working in different types of environments. And when you're in an environment where quality matters, it's this type of portfolio that I think could be important. The one, not caveat, but the one thing I should know, it's only fair, since we're talking about this, is, bond yields have come up a lot, and so that's something that investors now do have an option. You can get, decent yields on, 2-year and 5-year notes. You're still invested in bonds. It's a different animal altogether than equities. I mean, but, it's a very different environment, for people that have capital, short-term capital, that are trying to get some return on it than we were, 2 or 3 years ago. So anyways, just figured I'd make that point.
No, exactly. And you mentioned earlier, there's kind of the two sides to the dividends is you could have the opportunity to reinvest those dividends. For somebody younger, that's probably what they're going to be doing with those dividend payments and be able to, like you said, add to the compounding factor of the portfolio. But an older investor, and again, we don't know anybody's personal situation, so it's by no means advice, but typically you could utilize the dividends as a part of, kind of covering your whatever costs and your whatever income that you need to be generated, and you can rely on these types of companies to do that. But no, I mean, I think it's fantastic. Again, it's something a little bit different within the portfolio, within the EchoTrade environment, and I love the approach you guys have, and the fact that investors can get this kind of access within EchoTrade. And so investors, again, they can go to EchoTrade and they can invest and then subscribe to and copy the portfolio of Dividend Achievers, brought to you by Justin and Validia Capital. Justin, appreciate the partnership. Thanks as always for taking the time.
Thanks, Jeff.